There is a business in America that makes over $4 billion a year, and almost nobody thinks of it as a business at all. It has no competitors fighting for your attention. No Black Friday sales. No customer reviews on Google because the people who use the product the most never get to leave one. Every single day, roughly 8,000 Americans die, and every single one of those deaths creates a transaction, a plot of land, a hole in the ground, a piece of paper that says, "This 6 feet of earth belongs to you forever." Here's the part that should stop you. The land costs almost nothing to acquire. The product, 6 feet of dirt, never wears out, never goes obsolete, never needs restocking. And once you sell it, the customer can never return it, complain about it, or ask for a refund. Sounds like the perfect business, right? Except there's a catch. A catch so brutal that it has bankrupted cemetery owners, triggered state investigations, and left entire graveyards abandoned and overgrown, with lawsuits from grieving families still working their way through court decades later. Because here's the twist nobody tells you. A cemetery is a business that is legally required to keep a promise for eternity. It collects only once. By the end of this video, you'll understand exactly how a piece of empty farmland turns into a multi-million-dollar cash machine, and why so many people who try to run this business end up losing everything. Stick around, because the ending of this story involves a $73 million, I'll bet, a government trust fund nobody can touch, and one numbers that decides whether a cemetery survives for 100 years or collapses in 5. Let's dig in. Section 1. The industry nobody wants to talk about. Let's start with the numbers, because they're bigger than you'd think. The cemetery industry alone generates, cite in Sol 5.1, around $4.4 billion a year in the United States, and it's part of an even larger $57.8 billion death care industry. That's bigger than the entire US movie box office, bigger than the video game console market, and it's an industry most people actively avoid thinking about, which ironically is exactly what makes it so profitable. Here's the strange economic quirk at the center of this business. Site index equals 5-1. Most people steer clear of anything associated with death, which means there's very little competition from ambitious entrepreneurs. Think about it. When was the last time you saw a cemetery startup pitch on a business show? When was the last time a college graduate said, "I want to build the next great graveyard empire"? Nobody wants in. And in business, when nobody wants in, the people who are already in tend to do very, very well. There are site index equals 5.1, only around 7,100 cemetery businesses operating in the entire United States right now. And demand is not going anywhere. If anything, it's about to explode. There are 65 million baby boomers currently moving through retirement age, and every single one of them is eventually a customer. This is a business with a guaranteed, non-negotiable customer base. You don't need to convince anyone they need your product. You don't need influencer marketing. You don't need to compete on innovation. The market shows up on its own schedule, and it never ever stops showing up. So why isn't every real estate investor in America racing to buy up cemetery land? Because the moment you look past the surface, you find the trap. Section 2, how the money actually flows in 3-7-30. Let's talk about what a cemetery actually sells, because it's more layered than just a plot of land. Revenue stream 1, the plot itself. This is the most obvious one. You're buying the right to be buried in a specific 6 by 10 foot piece of land. Depending on where you are, this ranges wildly. Site index equals 3.1. A basic single plot runs $1,000 to $4,000 in public cemeteries and $3,000 to $10 0 in private memorial parks for site, with prices climbing even higher in dense cities. Site index equals 9.1. In places like New York City, a plot at an established private cemetery can run $20,000 or more site, while in the Southeast, you might find one for a fraction of that. Revenue stream, He's 2. Interment services. Here's where it gets interesting, and where the real profit tends to hide. Opening and closing the grave, literally digging the hole and filling it back in after the service, can cost site index equals 3.1 an additional $1,000 to $3,000. Then there's the burial vault, a concrete or metal container required by most cemeteries to stop the ground from sinking over time, which adds index equals 8-1, another 1,200 to $3,500. Revenue stream 3. The monument headstones and grave markers aren't optional in most cemeteries, and they're rarely cheap. Depending on material and size, families are paying seat index equals 8-1, 1,500 to $8, 0 CT for a piece of stone with a name carved into it, add it all up, and a simple burial. The kind most families think will be modest actually costs site index equals 8-1, somewhere between $12,000 and $25, $0 site once you include the plot, the vault, the monument, the opening and closing fees, and the maintenance charges. Now there's a twist that separates a smart cemetery owner from a struggling one. The plot itself is almost never where the real profit is. According to industry analysts, many cemeteries deliberately price their burial plots low, sometimes at a loss, specifically to get families in the door. Then they make their actual money on everything that comes after: the digging, the vault, the marker, the maintenance fee. If C index 5-1, if a cemetery undercharges for the burial plot, it makes up the difference by charging more for interment and the services around it. It's the same psychology as a razor company selling the razor cheap and making its money on the blades. Except here, the blade is a burial vault, and the customer only ever buys it once. So on paper, this looks incredible. Multiple revenue streams, high margins, a customer base that never stops growing. But now we get to the catch. The one that has quietly destroyed cemetery businesses for over a century. Section 3. The promise that never ends. 73013. Imagine selling a product and being legally required to maintain it for the rest of human history. That's not an exaggeration. That is literally the deal. Site index equals 7-1. In the United States, burial plots are generally sold in perpetuity, meaning that piece of land belongs to that family forever. Not for 30 years. Not for a lease term. Forever. Which means the cemetery has to keep that grass cut, those roads paved, and those grounds secure, essentially until the end of time. Now think through the business problem this creates. A cemetery has a finite amount of land. Eventually, maybe in 20 years, maybe in 100, every single plot gets sold. And the moment that happens, index equals 5-1, the cemetery loses nearly all of its ability to generate new revenue. There's nothing left to sell. No new plots, no new customers, no new cash coming in, but the maintenance obligation doesn't stop. The grass still grows. The fences still rust. The roads still crack forever. So how does a cemetery pay for infinite upkeep using revenue that runs out? This is where the perpetual care fund comes in, and it might be one of the most fascinating financial instruments most people have never heard of. Here's how it works. Nearly every U.S. state legally requires cemeteries to set aside a percentage of every single sale. The plot, sometimes the vault, sometimes the marker, into a dedicated trust fund. That money doesn't go to the cemetery owner. It doesn't go toward payroll. It gets locked away, invested by a third-party trustee. And only the interest generated by that trust can ever be spent, and only on maintenance. Site index equals 6-1 Montana. Cemetery companies are required to deposit at least 15% of every sale into this fund. In New York, it's a minimum of 10% of gross proceeds site, plus additional set amounts for every single burial. Must index equals 6-1. The core principle of that fund must remain untouched forever, administered with the same level of care a prudent trustee would use for any long-term trust. Only the income the fund generates can ever be spent, and only on the cemetery's upkeep. Think about what this actually means for a cemetery owner. You sell a plot today for, say, $5,000. Instantly, hundreds or even $1,000 of that sale vanishes into a trust you can never touch. You don't get to use it for advertising, staff wages, or expansion. It's gone, locked into an account that's meant to still be paying dividends 200 years from now. This is the mechanism that separates a legitimate cemetery business from a ticking time bomb. Because here's the part that should genuinely worry you if you were ever considering this business. That trust fund has to be big enough and grow fast enough to out-earn inflation forever. If a cemetery underestimates future maintenance costs or the trust doesn't grow fast enough, there's a growing gap between what the land needs and what the fund can pay for. And when that gap gets big enough, the grass stops getting cut. The roads stop getting repaired. And you get exactly the kind of overgrown, abandoned cemetery that shows up in horror movies, except this one is a real financial failure, not a Halloween set. Site index equals 6.1. Some of the largest cemeteries in the country are sitting on over 220,000 individual burials. And even with a fully staffed maintenance crew, giving meaningful attention to every single grave once per growing season would require tending to more than 1,800 graves a day. That's simply not possible within any realistic budget. So even the biggest, most well-funded cemeteries in America are quietly making a bet that their trust fund investments will keep outpacing the cost of maintaining land that never generates a single new dollar again. Now pause and really sit with that for a second, because this is the part that separates a cemetery from literally every other business on the planet. A restaurant can close tomorrow. A software company can shut its servers down. A retail chain can liquidate and walk away. But a cemetery has made a promise to thousands of families, sometimes tens of thousands, that cannot be broken, cannot be renegotiated, and cannot expire. It is, in a very literal sense, a business built to outlive its own founder, its own investors, and possibly the country it operates in. That's not a metaphor. Some of the oldest operating cemeteries in the United States predate the income tax, predate the automobile, predate electricity in most American homes. And they're still collecting interest off perpetual care trusts that were first funded before anyone alive today was born. If that doesn't reframe how you think about long-term investing, nothing will. Section 4. What happens when the money runs out? 13 to 17. Not every cemetery gets this right. And when they get it wrong, the consequences are almost eerie. Site index equals 7-1. Cemeteries rarely file for bankruptcy in the traditional sense, but when the money truly runs dry, the local municipality sometimes has to step in and take over maintenances. In other cases, it's volunteers, often the descendants of the very people buried there, who show up with lawnmowers because nobody else will. A site index equals 7.1, and because there's no federal law preventing cemetery land from eventually being repurposed, there have been real cases where courts allowed developers to buy abandoned cemetery land, rezone it, and build on top of it, with the previous owner, or sometimes the grieving families themselves, left to cover the staggering cost of relocating the remains. Let that sink in for a second. A business model where the failure state isn't just you lose money, it's someone has to dig up bodies. That's the kind of downside risk see in almost any other industry. You can walk away from a failed restaurant. You can declare bankruptcy on a failed retail chain and liquidate the inventory. You cannot simply walk away from thousands of families who paid you, in some cases decades ago, for a promise of eternal care. This is why some cemeteries have taken a completely different approach to survive. Instead of standing alone, they merge with a funeral home. One cemetery manager in Arkansas explained it simply: site index equals 7.1. Having funeral home staff work double duty at the cemetery is what keeps overhead from spiraling out of control. Site, because you're not paying two separate teams for landscaping, admin, and customer service. It's one operation instead of two, splitting costs across two revenue streams. Compare that to what happens with public, government-run cemeteries, the ones without a perpetual care trust behind them. Index equals 7.1. One Arkansas City cemetery charges a flat $400 per plot, no matter the size or location. As a result, it doesn't come close to breaking even. In one recent year, the city spent nearly $149,000 maintaining the grounds while only bringing in around $80,000 in revenue. Meaning taxpayers are quietly subsidizing the difference, year after year forever. That's the fork in the road. Either you charge enough up front, build the trust fund correctly, and survive for centuries, or you undercharge and someone else, a city, a volunteer, a distant relative, ends up footing the bill long after you're gone. Section 5. The Modern Cemetery Startup, 1721. Now here's where this gets genuinely wild, because cemeteries aren't stuck in the past. There's a modern version of this business happening right now, and the numbers are almost unbelievable. Take the natural burial ground trend. Eco-friendly cemeteries with no embalming chemicals, no concrete vaults, just biodegradable caskets and native landscaping. It sounds simple. It is not cheap. One recent financial model for launching a natural burial ground cemetery estimated the venture would require a minimum cash investment of over $73 million, factoring in land acquisition, environmental certification, and construction, with a break-even point projected only after roughly 2 years of operation. In year one alone, the model projected a loss of over $500 million on paper, before swinging into meaningful profit by year three, with EBITDA projected north of $7 million. That's the terrifying part of this business that most people never see. The upfront capital requirement is enormous, the regulatory hurdles are heavy, and the perpetual care contribution, sometimes over 100% of a plot sale price when you include marketing and trust obligations combined, eats into your margins before you've made a single dollar of real profit. And that number is not a typo. In some models, sales and marketing commissions on premium plots start as high as 85% of the sale, meaning that on a purely mathematical basis, a cemetery makes almost nothing on its first wave of sales. The entire early period exists just to build enough volume and trust fund balance to survive long term. This is why the death care industry has increasingly consolidated into a handful of massive, publicly run corporate players. Companies with the balance sheets to absorb years of upfront losses in exchange for decades, sometimes centuries, of steady recession-proof income afterward. Because here's the thing about a cemetery's revenue: it doesn't care about the stock market. It doesn't care about interest rates or inflation scares or a bad quarter in tech stocks. People die in recessions exactly as often as they die in booms. This is one of the only truly recession-immune businesses on Earth. Section 6. The slow shift that's quickly threatening the industry. 21-24. But even a recession-proof business has a threat. And this one is coming from an unexpected place: changing customer preference. Cremation is rising fast across the United States, and it is quietly rewriting the entire cemetery business model. A cremation niche, a small space in a columbarium wall to hold an urn, costs a fraction of a traditional plot, sometimes as little as $500. Site Index 6-1. Meanwhile, lower spending on traditional death care services overall is starting to squeeze sales of higher value grave sites, vaults, and monuments, the exact products that generate a cemetery's healthiest margins. Picture it from the cemetery owner's side. For decades, your entire financial model was built around families buying a full plot, a vault, a marker, and paying for a full-size opening and closing. Now, more and more of your customers want the cheapest, smallest option available. Your average revenue per customer is shrinking, right as your perpetual maintenance obligations keep growing every single year with inflation. This is the quiet, unglamorous story playing out behind cemetery gates across the entire country. It's not a dramatic collapse. It's a slow erosion of margin, year after year, forcing cemetery owners to get smarter, leaner, and more diversified, expanding into cremation gardens, event spaces, even wedding venues on historic cemetery grounds, just to keep the revenue flowing. Section 6.5. The real playbook. How cemetery owners actually protect themselves. 24-27-30. This brutal. How does anyone survive in this business long term? It turns out the owners who last decades all tend to follow the same handful of rules. And once you hear them, the whole industry starts to make a lot more sense. Rule 1. Sell fast, sell early. The single biggest killer of a new cemetery isn't bad management. It's slow sales velocity. Every month that plots sit unsold is another month of fixed costs, property taxes, land management, professional fees, draining cash with nothing coming in to replace it. This is why so many cemeteries lean hard into pre-need sales, convincing people to buy their own plot decades before they'll ever need it. It sounds morbid, but from a purely financial standpoint, it's genius. You get the cash today, you get to invest it today, and the customer locks in today's price before land values climb further. Rule 2. Never rely on the plot alone. As we covered earlier, the real margin lives in the vault, the marker, the opening and closing fee, not the dirt itself. The smartest operators treat the plot almost like a loss leader, a way to get a family through the gate, and then build their actual profit around everything that follows. Rule 3. Diversify beyond burial. This is the newest trend reshaping the industry. Historic cemeteries, the ones with sweeping lawns, mature trees, and ornate Victorian-era architecture, have realized they're sitting on some of the most beautiful real estate in their entire city. Increasingly, these grounds are hosting garden tours, photography sessions, even weddings and corporate events on the parts of the property that are landscaped but not yet sold as burial space. It's an unconventional pivot, but it turns idle land into active revenue without touching a single grave. Rule 4. Respect the trust fund no matter how much it hurts. Every operator we've looked at who cut corners on their perpetual care contribution, shorting the trust fund to protect short-term profit, eventually paid for it, either through state penalties, through a shrinking maintenance budget a decade later, or through a full public collapse where the local government had to step in. The trust fund isn't a suggestion. It's the entire reason this business is allowed to exist for centuries instead of years. Rule 5. Merge operations wherever possible. As we saw with the funeral home plus cemetery model, combining services under one roof spreads fixed costs, staff, equipment, admin, across multiple revenue lines. A standalone cemetery with no complementary business is fighting with one hand tied behind its back. None of these rules make the business easy, but together they explain something important. The cemeteries you see standing today, some of them over 150 years old, with perfectly manicured lawns and thriving trust funds, those aren't accidents. They're the survivors of a filtering process that has quietly wiped out thousands of poorly run competitors over the last century. Section 7. So, should you ever own one? 2830. So let's bring this back to the question that's been sitting underneath this entire video. Is owning a cemetery actually a good business? The honest answer is, it depends entirely on your time horizon and your stomach for risk. If you're looking for fast returns, this is one of the worst businesses you could possibly choose. The upfront capital requirements are massive, the regulatory hurdles are heavy, and a meaningful chunk of every dollar you make gets locked away in a trust fund you can never personally spend. But if you're thinking generationally, if you're building something meant to still be standing in 200 years, a well-run cemetery might be one of the most durable businesses that has ever existed. It has a customer base that will never disappear, demand that never dries up in a recession, and a legal structure specifically designed to make sure the business, or at least the land and the promise attached to it, survives long after you do. It's not a business you build to get rich quick. It's a business you build to become permanent. And maybe that's the real uncomfortable lesson hiding inside all of this. A cemetery isn't really selling death. It's selling permanence, the one thing every human being deep down actually wants to buy. If you've made it this far, you now understand something about the death care industry that most people never think about in their entire lives. The hidden mechanics behind one of the strangest, most misunderstood businesses on earth. If you want to see how this compares to some of the other unusual businesses we've broken down, from toll roads to private islands, the next video is waiting right there on your screen. Thanks for watching.